This is the Asia Trade. I'm Shery in Seoul.
I'm Haidi. Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian shares are set to extend gains from Wall Street, where big tech helped snap a two-day slide. The US inflation numbers cementing expectations for a Fed cut next week. Tesla among the winners, shares hitting their first record high in 3 years, with more than $500 billion pouring in since Donald Trump's election win. And China's Yuan in focus on a report that Beijing is considering allowing a weaker currency next year in response to a potential US trade war.
And that really spiking the US dollar in the overnight session, which pressured markets across Asia. We're talking about the Kiwi dollar also falling to the weakest level against the US dollar in more than 2 years. The Aussie also hitting levels last seen in November. A lot of volatility in the markets, especially in Japan, given that we're headed towards that BOJ rate decision. And there's really no clarity about what to expect. So market bets have really sharply swung throughout the week. We're watching, of course, Korea's political developments, as well as President Yoon is determined to fight impeachment, according to a senior ruling party member. But take a look at how U.S. futures are now setting up as well, because we saw stocks rising for the first time in 3 days. We had big tech leading those gains, with the Nasdaq 100 climbing to a record. It was an expectation of an AI deal between Apple and Broadcom following a report that led to that surge. And of course, it's all about U.S. inflation, of course, Haidi, because they came in line with the estimates setting perhaps the groundwork for a Fed rate cut.
We continue to watch these prospects of what Trump 2.0 government is going to look like, particularly when it comes to those global trade policies. We do have some breaking news just crossing the Bloomberg here. Donald Trump has invited China's Xi Jinping to his inauguration, according to reporting from CBS. And quite interesting to see how this potentially plays out, given that, of course, we've seen kind of a lot of to and fro and a lot of campaign rhetoric in terms of how hawkish the Trump administration this time around plans to continue coming down on China. We know that this is also really one that has been up by the Biden administration as well, you know, upping some of those sort of tariff pressures and restrictions, particularly in the tech space, even before we see that Trump administration taking the White House. And we did speak a little bit earlier about the Yuan in focus and whether the currency is really one way that we could see Beijing responding. But at the same time, Shery, we know that Donald Trump loves a deal, and if we do see kind of a warming of ties, that would certainly be welcomed by the markets.
Yeah. Investors, economists watching that very closely, especially given the inflationary implications of potential tariffs, right? For more on the latest U.S. inflation data, let's bring in Bloomberg economy and Federal Reserve reporter Janelle Martigny in New York. Janelle, so could you break down the latest CPI numbers as we're now headed towards PPI data as well?
So as you mentioned, the numbers came in pretty much as expected. So the fact that the surprises weren't too scary, that means that it's pretty much set that the Fed will likely cut interest rates again at the meeting next week, as they have been signaling. Now, because it has now been 4 months of inflation, core inflation coming in at the same level, it did raise some concerns. It is raising some problems for the people who are saying maybe there's progress, maybe the progress that we had been seeing on inflation is slowing down.
Janelle, we continue to kind of watch these possibilities of trade pressures, right? And we just had the news that CBS reported that Xi Jinping has secured an invitation to the Trump inauguration. How much risk is there when it comes to the inflation outlook, depending on what sort of fiscal policies we get next year?
So a big theme, of course, as we look into next year is the uncertainty. You're pointing out a few things. We really do not know what the fiscal policy picture is going to look like, and we don't know what that will mean for inflation, especially at this moment where there are concerns that inflation may be stalling out. The Fed has seen a lot of improvement in prices in the terms of, you know, we're getting closer to the 2% target that they have, but we're still above that. And so interest rates are still high. Policymakers in general want to continue to bring borrowing costs down, but when there's a lot of uncertainty about what the economy will look like, what we're going to see in terms of tariffs, what that could mean for price pressures down the line, it makes it a muddy picture for them in terms of figuring out just how much should they be lowering borrowing costs in the next year. And it also is leading to questions about maybe they will not be bringing down borrowing costs as much as they thought they were going to, given that if inflationary pressures do persist, they might want to keep rates higher for longer.
Our Bloomberg economy and Federal Reserve reporter Janelle Marte there in New York. And let's bring Amy Patrick, who's the head of income strategies at Pendal Group. You didn't really expect this data release to kind of, change the outlook or move the needle, if you will. What are you looking out for then in terms of potential kind of risks and things that could change the picture?
I am still keeping a keen eye on the way that the inflation data evolves over the next few months. So I'm surprised in the conversation that I just overheard now that nobody mentioned supercore. It wasn't that long ago that the Fed highlighted supercore, which is, if I remember correctly, it's core services inflation ex shelter or ex housing, I think. And it's kind of sticky. It's above 4%, which is clearly not where the Fed would like it to be. I'm a little bit perplexed about why this is still the case, given that you're seeing wage pressures come down. You're seeing goods still very much in deflation as well, and other parts of services. Maybe it's a seasonal effect, but that's a little concern I have.
Does that mean you're still looking for upside inflation protection in some respects, or is that not something that is a key kind of investing thematic for you going into next year?
For me, the way it plays out in my investment decisions is it keeps me sort of reined in terms of getting overly bullish, overly optimistic about bonds. We have been talking about how the Fed's decision this time round doesn't necessarily, it wasn't ever going to depend on this inflation print all that much, because so much of their decision in December is already priced in. But the market is still to be, overly optimistic in terms of pricing in a much sharper rate cutting cycle next year. And at this stage, given the way that the inflation data is unfolding, I share a little bit of that market's caution as well.
How cautious are you about what's happening in China right now? Because investors or markets don't seem to be reacting too much until especially they see some details out of the Politburo shift in tone.
Yeah, so I take a slightly more medium-term lens with respect to the China story. If I think about the bigger picture stories that have been unfolding in China, they're deeply structural. And they're to do with an economy that's trying to find a different engine of growth and a different model for growth after still yet needing to deal with a massive bubble bursting, a debt bubble bursting in the economy. So I think the thing that continues to be missing from the China stimulus message is how will they deliver fiscal stimulus more directly to consumers so that the economy can more meaningfully shift from being investment-led to consumption-led. That piece will continue to be missing, in my opinion, as long as they're still dealing with the aftermath of the debt bubble bursting, of needing to find a different engine to take over from property.
Given what you're saying, do you then take the reports that Beijing is looking at allowing its currency to weaken in order to get ready for a trade war as being more of a warning sign? Because when it comes to actually stimulating the economy, that would help exports, but I'm not quite sure how much that would help internal demand. Still, when it comes to the markets, what are the implications of a disorderly yuan devaluation?
I think, warning on a weaker yuan, it just makes economic sense, right? Because when I think about the policy settings in China, it's very clear that with an economy that's still in deflation, the rest of the world is still talking about inflation, but China, the problem has very much been about deflation. Policy rates are too high. It's too restrictive a monetary policy setting. But lowering them is just the first step that's needed. It's a necessary but not sufficient condition to getting the economy going. So if they know that one of the key policy tools that they will be implementing next year is bringing interest rates down, and the bond markets in China have already been pricing that in quite materially, then necessarily the currency's got to weaken. So I think the warning, it serves well as maybe a warning, but actually, a disorderly devaluation is the last thing that Beijing wants to see. And maybe a slightly controversial prediction, but between Xi Jinping and Trump, it's quite likely that they may strike a deal where actually they both agree to boost the value of the yuan relative to the US dollar, because right now, at least on a tactical time horizon, they're both aligned in terms of wanting that.
So you talk about a deal. I mean, it seems highly unlikely, at least if history is anything to go by, that Xi Jinping is going to attend Trump's inauguration. But, the man does love a deal. And from China's perspective, it'll be good to sort of save face in that respect too, right? So broadly, do you expect some of the fears about a global trade war, some of the sort of hawkishness from the US to be tampered down into these more sort of pragmatic handshakes?
I do, and I do think that China is in a weaker bargaining position this time round as well. It's really hamstrung in terms of what kind of stimulus it can deliver this time round versus what happened the first time round there was a trade war imposed by Trump. So China, I think, is also more incentivized to strike some kind of a middle ground, at least whilst it gets itself out of this mess of dealing with, the property bubble bursting. So I do think that, the fears, I'm not going to say the fears are overblown because we still don't really know the full extent of the policies that are going to come through. But I do think that it's in both parties' interests to strike some kind of a middle ground. And as China has shown, rather than coming back with tit-for-tat tariffs necessarily, there's also things that China can do that will impact the high growth end of the US stock market. And as far as Trump's, live polling is exhibited by how the S&P 500 is doing, I think he'll care about that as well.
And certainly caught in the crossfire, of course, is countries like South Korea that has its own political chaos to deal with. The markets, though, seem to have stabilized. What do you think?
So with things like these geopolitical and political crises, look, it's been so dramatic what's happened in Korea over the last week. But I would argue that, for me, the deeper concern for Korea and Korean markets and asset prices related to Korea is, where are we in the trade cycle? Right? Is a massive global trade war about to be ignited by the policies of Trump? Because that would hurt Korea far more than the political dramas that are unfolding in the country in and of itself. But I do look at the underlying trends. So regardless of what Trump manages to bring in, the underlying trends look like this to me. China is slowing. China's demand for global products is slowing. Korea is a massive global manufacturing exporter. And the latest prints on Chinese import numbers, what China's sucking in from the rest of the world, continues to show a picture of very lackluster Chinese demand. Global demand is also slowing. The European economy is slowing, not without its own political concerns as well. So more than the political tensions that have been unfolding in Korea, I think what matters more is the direction of travel for global trade. And here again, I would argue that the path of least resistance is probably for the Korean won to continue to weaken against the US dollar.
Amy, always really good to have you with us. Amy Patrick, who's the head of income strategies at Pendal Group. We do have more ahead here in the Age of Trade. This is Bloomberg.
Wednesday, the Fed decides.
The consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause.
Yeah, but it's pretty high bar.
All of this seems very predictable.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
People feel good about where the economy is. Demand is obviously pretty strong. If there were black clouds on the horizon, what would they be?
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
South Korean President Yoon looks determined to battle on rather than step down early, even as investigations deepen into his martial law declaration and more members of his party say they will back impeachment. The Hangyeol newspaper says the leader of Yoon's ruling People Power Party, Han Dong-un, could show support for the impeachment motion against the president as early as today. For more on the latest, we're now joined by Bloomberg News' Hee-jin Kim. Hee-jin, so now we're hearing from Donga News here, local media, saying that 6 ruling party lawmakers will be supporting the impeachment. Of course, The reason that the impeachment bill didn't pass over the weekend was that we were short of that 8 votes needed. What's the latest right now?
Yeah, sure. So we are hearing from our own sources that President Yoon is privately talking to his aides that he actually wants impeachment rather than he's just stepping down. And then it seems like he's hiring his own lawyers and he really wants to explain to public, probably at the Constitutional Court after the impeachment vote, that why he made this decision, what exactly happened on the day. So what we are expecting this week is basically today, the opposition Democratic Party will propose a motion to propose a vote this Saturday. And there will be a vote on Saturday. And we are expecting a bunch of ruling party lawmakers participating this time, not just 10 or 12 people as we saw last week. Because, just like President Yoon, if he wants impeachment, definitely his ruling party members definitely vote for him, right? Yeah.
That's the thing, right? Local media here are saying that perhaps it's trying to buy time to take the impeachment into the Constitutional Court. Explain to us the process that would happen if, in fact, he's impeached.
Yes, the process will be pretty long, even if the vote is actually passed this Saturday. So the Constitutional Court will have to decide whether they're going to impeach Yoon or not within the 6 months. And the last time we impeached South Korea, impeached the President Park Geun-hye, it took 3 months for the Constitutional Court to do so. And although at the time Park Geun-hye didn't appear at the court, but we are expecting this time President Yoon, probably definitely he will appear at the hearings with the Constitutional Court justices so that he can explain a lot about what happened on the day.
Kim Hee-jin, thank you so much for that update, joining us from Bloomberg News. And of course, Haidi, just a reminder that today is the anniversary of the so-called coup d'etat of December 12th, back in 1979, when General Chun Doo-hwan created a dictatorship. And if anybody wants to know more about that, you can actually find a very popular Netflix movie about it.
Shery, that sort of takes on a very different sort of sense of significance this year, right, given the events of the past few weeks. We are also, of course, watching what's going on in Beijing. Shery, we're speaking a little bit about, some of the sort of tactical weakness that we could maybe see in the currency in response to any trade pressures from a Trump administration. But at the moment, we're also seeing the annual Economic Work Conference setting those policy priorities for 2025. That's set to wrap up later on Thursday. The top leadership has been busy preparing perhaps some of these bargaining chips for a potential trade war. Let's bring our Chief North Asia correspondent, Stephen Engle, in Hong Kong. So currency has long been sort of floated as one of these options.
Yeah, so the big question is how many tools are in the box for China to retaliate, if you even want to call it retaliate, without causing obvious blowback to its own economy, as well as a very fragile U.S.-China relationship that, let's face it, China doesn't want to decouple. It does need the relationship with the United States. But again, Donald Trump has clearly telegraphed his intent to use tariffs and to increase tariffs. It could be Donald Trump's obvious own bargaining chip as well, ahead of any attempt at some sort of trade deal 2.0 in Trump White House 2.0. But again, the Beijing leadership, as you see here, led by Xi Jinping, has to prepare for all eventualities. And that's why this Central Economic Work Conference, which is going to be wrapping up in Beijing today, is going to be likely dealing with all of these scenarios, with the emphasis on the domestic economy, of course, to protect it, to shield it from any blowback from a trade war and those increased tariffs. We had the Politburo talk about a moderately looser monetary policy, a forcefully support domestic consumption. All these things to shore up the Chinese economy while dealing with the potential eventuality of an increased trade war. But the biggest issue is Chinese economy right now is not on strong footing like it was in the first Trump administration. So how many tools do they have? Now, in response to the latest Biden moves, they've opened a probe into NVIDIA, China has. They've banned export of several rare materials. They've limited sales of key components used to manufacture drones. They've also stepped up its use of anti-dumping and countervailing trade investigations, and they seem to be more willing to to really flex its strengths on supply chain as well as those key materials. But again, the big question is how far can they go, and are they willing to go at the expense of their own domestic economy?
We're hearing that a potential tool could also be a weaker yuan, but that also carries risks.
Absolutely. And again, it goes back to the blowback on the domestic economy. If you weaken the currency, obviously you give your exporters, a better boost, cheaper exports. But at the same time, it could spur those much dreaded outflows. China has capital controls for many good reasons of its own justification. But a massive outflow would only undermine the attempts to attract foreign capital and to strengthen the Chinese economy. So, already the looser or moderately loose monetary policy for 2025, in theory, would mean a weaker yuan or more pressure on the yuan. And we're hearing other media have reported essentially that the Chinese leadership simply or sort of has a target of around 7.5 to the U.S. dollar. It's about 7.3 for the CNY onshore right now. So 7.5, that would be more of a managed depreciation, not an outright disorderly, devaluation, obviously, which would do China absolutely no good. We saw it in 2015, the chaos that ensued. So a managed depreciation to about 7.5 is what we're hearing is what the Chinese leadership perhaps is discussing. They're not going to announce it, I'll guarantee you that, at the Central Economic Work Conference that is going on right now. That sets the priorities for the National People's Congress coming up in March.
Chief North Asia correspondent Stephen Engel there. More ahead on the Asia trade. This is Bloomberg.
Barring some shock, the CPI numbers will trend down next year. And, the next few months are going to show some high year-over-year numbers.
Yes, the rent component's coming down, but as he mentioned, there's other elements that have been negative that are now going positive again. So it's really a give and take.
Notwithstanding the CPI print this morning, I think we're still pricing a greater likelihood of a 25 basis point cut into the end of this year.
So I do expect that the dot plot next week will be a little bit more cautious than the one in September.
As we head into 2025, there are some uncertainties. We'll have to see what types of policies present themselves. We'll have to see how the economic growth continues to unfold. There currently are more cuts priced into 2025.
Some of our guests reacting to the US CPI print, as we also saw the US dollar spike on a report that Beijing is considering allowing its currency to weaken as they brace for higher tariffs and a trade war under a Trump presidency. This as the euro is now looking like this against the US dollar. Not a lot of movement, but this is as we head towards an ECB decision, which is likely to lower rates by 25 basis points. We have seen the outlook for inflation and GDP growth, both darkening since the ECB met last time. Now, we didn't see much of a reaction when it came to EM currencies, perhaps a little bit more downside after the U.S. inflation print that showed that those bets on Fed rate cuts are rising. But the Brazilian real, in the meantime, continued to gain ground, and you can see that upside right there. For the third time already, a central bank in Brazil raised its benchmark rate by 1 percentage point and also promised 2 more rate hikes of the same size in the next 2 meetings. Of course, we do have the Fed policy decision next week, the BOJ, as well as we continue to watch the yuan volatility as well. We have more ahead on the Asia trade. This is Bloomberg.
US Treasury Secretary Janet Yellen is urging the incoming Trump administration to maintain the dialogue channels that she's re-established with China. She spoke to us exclusively ahead of what may be the last round of economic and financial talks with Chinese officials under the Biden presidency.
It's important to have ongoing communications at all levels, from the president and Xi talking to senior U.S. officials, to staff that need to communicate. Just having open channels of communication is valuable, and I believe it will be seen as continuing to offer value. These are channels by which we can make clear what we're unhappy about, where our concerns are and why we have them. Well, we have significant concerns about Russia's economic policies that we discuss in these channels. It's also the case that we have shared global interests, whether it's in climate change, combating pandemics, dealing with potential financial disruptions that could affect global financial markets. We're also using these channels to build trust in channels for cooperation so that we can work together where our interests coincide. So there's no question that we have serious concerns both from a national security point of view and a broader economic view with China's behavior. But nevertheless, as the two largest economies in the world, it's critical to have open channels of communication. It helps avoid misunderstandings. We've used these channels when we've taken action like export controls or our recent outbound investment restrictions to explain what we're trying to accomplish to avoid misunderstandings that can worsen the relationship needlessly.
You have a particular insight into what makes your counterparts tick, I imagine, through those conversations that you've had. And so we've seen the President-elect talk about large, universal, punitive tariffs. Do you have any insight into how they might respond if they are threatened with something like that?
Well, I really don't want to make a forecast. Many countries, when they're faced with unilateral actions of that sort, look for ways to retaliate, and my guess would be that they would do that. We have in areas of concern where I've expressed repeatedly concerns with overcapacity that is developed in Chinese advanced manufacturing industries and clean energy, semiconductors, and the like. We think it reflects active, large subsidies that are flooding the world with exports and threaten to drive our firms out of business in areas that we think are critical to our own future. We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
U.S. Treasury Secretary Janet Yellen speaking to Bloomberg's David Gura there. And of course, this as we continue to watch for implications of tariffs on the inflation path, not only for the Fed, but other central banks around the world. We continue to watch what the BOJ might do next week. But traders seem pretty confused because swaps pricing in a 19% chance of a December rate increase, and that is a sharp plunge from 60% at the beginning of last week. We continue to see this mixed signals coming from BOJ officials, not to mention media reports as well. And we have heard also from Bloomberg reporting that BOJ officials see a small cost to waiting to hike rates. Let's actually get to our government and economy editor, Paul Jackson. Paul, what have we heard?
Just what you said, that there's a little cost, little downside to waiting a little longer before raising rates. So I think the takeaway from that is that our base case scenario now is a January rate hike. I think we still need to be wary of a move next week. But our baseline is January. If you look at how those swaps have changed, how market expectations have changed, there's this feeling that the mood has swung from December to January. And let's see, what could the reasons behind that be? Well, inflation isn't surging out of control, so there's no great rush to raise interest rates. The yen isn't banging on the door of 160, so that also gives the BOJ some breathing space. Also, I think we need to consider the politics of this. Japan has a minority government that is trying to pass both an extra budget and an annual budget. And I think if you look globally, you'll see that minority governments trying to pass budgets can be problematic. Just look what's happened in France and South Korea. Now, of course, I'm not suggesting that's about to happen in Japan, but it does point to the need to be sensitive to also what's going on in the political realm. And certainly one of those parties that the LDP is dealing with in Japan is against rate hikes coming too quickly.
What's the view in terms of what we've heard from the BOJ, right? Because there's a specific and fairly high-profile speech that we're looking forward to in January. Is this sort of perhaps in response to some criticism about the communications that we've had?
Well, there has been criticism of the communications. If you remember, in July, there was a bit of a vacuum in BOJ speakers beforehand. So no one was kind of knowing what the latest thinking of the BOJ was from the speakers themselves. So I think although people in the know did expect them to move in July, there were some people blindsided in the markets. So this recent announcement that the deputy governor is going to speak in January, before the January meeting, I mean, it does look like the central banks announced that because it's wanting to steer expectations towards January. So if they did move next week, I think that would be seen as a poor move and another miscue on the communications. But as I say, our baseline is January. One thing, just a note of caution: Ueda is the great normalizer. He does want to use every possibility to raise interest rates when he can. So I think if there was no other factors in consideration, I think he would go next week. But for the reasons I've mentioned, our baseline scenario is now January.
Right, Paul Jackson, our economy and government editor there, joining us from Tokyo. And talk about politics impacting the economy. Here in South Korea, the finance minister Choi Sang-mok says the country is facing greater downside economic risks as it tries to mitigate the impact of the political turmoil on the won. Bloomberg's Korea economist Hyo-sung Kwon joins us now here in Seoul. So how do you see this crisis, especially if it gets protracted, because we might potentially be headed to another impeachment vote, which might go to the Constitutional Court and so forth? How is all of this going to affect the economy here?
Thanks for having me, Shery. Big concern is the prolonged political instability. So it threatens to undermine South Korea's economy at a critical time. So consumer confidence may fall, and households could reduce spending. Businesses may delay investment with high uncertainty. And foreign investors could lose confidence in South Korea's economy and reduce capital inflows. And we could see fewer foreign visitors next year, which will hurt the tourism sector. This comes on top of weak domestic demand and slowing exports, while the incoming Trump administration trade policies poses a significant downside risks. Combined together, these pressures could weigh heavily on South Korea's growth next year.
Which is kind of interesting, right? Because a lot of people were comparing it to what happened in 2016 when Park Geun-hye was impeached, but supposedly the economy was stronger back then. Is there anything that the BOK can do at this point? Because the Bank of Korea already cut rates consecutively twice.
I think that the BOK's monetary policy direction is quite clear. Further easing is on the horizon. Even before this political turmoil, Governor Chang Yong-lee signaled this. He said that the economy will be running below its potential next year. That highlights the need for additional fiscal stimulus, policy stimulus, and I think the BOK will cut interest rate below the neutral rate, which I estimate to be 2.5%. So rates to be go below 2.5% next year, and the reason that political instability has added more downside risks to the economy, which could mean deeper and faster rate cuts.
What about the budget that was finally and forcefully passed through Parliament? Is that going to make a difference?
The downside budget reflects deep political divide in South Korea, and it could undermine economic recovery next year. Currently, the Korean economy faces a weak domestic demand, private demand, and slowing exports, which means that the economy needs more targeted support from the fiscal side. But reduced budget, the government has probably weakened government's ability to implement policies effectively. So I estimate that fiscal spending will be a drag on growth next year. And in the end, it could add pressure on the Bank of Korea to ease monetary policy aggressively next year. Yeah.
Bloomberg's Korea economist Hyo-sung Kwon here with a look at the South Korean economy, Haidi, as we continue to wait for that potential impeachment motion to again be passed today.
Watching that very closely, and Shery, watching for sort of some indicators when it comes to Australia's labour market as well, with that jobless rate that could be seen to rise for November, and that broader report expected though to show moderate jobs growth and a bit of a tick up in that jobless rate. But we are seeing a little bit of upside when it comes to trading in the equity session, about 0.4% higher. We're just about 40 minutes through the course of trading. Some of that leadership coming from energy as well as consumer stocks at the moment. A bit of a dip when it comes to Australian bonds, though, ahead of that labour market data, and the Aussie dollar holding pretty steady. And the record-breaking stock rally, meanwhile, poised to extend as signs of more policy support emerge and investors look for markets largely shielded from geopolitical tensions. I'm bringing out stocks reporter Georgina McKay. And, Georgie, even a note just crossing my inbox from Jefferies this morning saying they like Australia. It's expensive, of course, but the macro picture is pretty robust. And perhaps key, limited Trump impact, which is interesting given the exposure to China. Is that kind of the optimism that we're hearing?
Yeah, absolutely. So Australian stocks are up about 10% this year, and that we've had banks trading at crazy valuations and all of these things. And heading into the new year, analysts and investors are still optimistic. They think that the market is going to gain, perhaps not at the breakneck speed that we've seen this year. And there's a few factors behind that. So firstly, as you said, possibly shielded from the Trump tariff threat, Australia can be seen as something of a safe haven, which we saw when investors were looking to seek shelter from China, moving capital into Australian banks, which sort of was part of the reason behind those sky-high valuations. And then on the other side, we are coming into an election, which has to be held by about May. And before that, we might see the government spending a lot to woo investors, and then that could prop up general growth in the economy. And then we also have, finally, a rate cut coming through sometime in the first half. Pricing for a Feb cut is looking a little bit more positive. I think it's around 70% last time I checked. And then around that April-May mark, we will probably definitely have seen a hike. So then that, in turn, will boost consumer sentiment, you would think. And then the equity market might get all of those consecutive boosts in the first half. So it should be a good one for stocks, but we'll see what happens with the China stimulus. That could have impacts on the mining sector, and then obviously with the Trump situation, how that sort of comes through in the market here and globally.
Yeah, the China stimulus is an interesting one, right? Because you could see that benefiting some of the consumer names, wineries, for example.
Yep, so for Treasury wine, if we're seeing boosted demand in China, that'll help that company. And then in terms of the mining sector, which is something quite interesting on that theme, right back when we first started hearing about this stimulus, we immediately saw capital leave banks and then go into the mining sector. And then the other day, when the narrative shifted again to more the optimistic side of things, that the stimulus will come through in a positive way, then miners got a lift again. We're going to see more of that next year. How much, how it plays out is going to be interesting and something to watch. And then how much capital is coming out of the banks, the two most heavily weighted sectors, and how that's translating into the broader benchmark will be interesting. And then part of the government's possible fiscal spending plans that might also present itself in tax cuts for miners, and that could represent a further lift. So some people are definitely cautious on the mining sector. They've had a rough year, and a lot of it, the sentiment in general around iron ore demand has been on that China stimulus theme and if it's going to come through. So it's definitely one to watch.
Our stocks reporter Georgina McKay there. More ahead on the Asia trade. This is Bloomberg.
With 2024 almost certain to be the warmest year on record, we're keeping a close eye on extreme weather events and their economic impact. The anticipated La Niña climate phenomenon has yet to arrive, and the difficulty of forecasting is poised to send commodities from energy to food on a volatile path. A series of storms last month battered economies from Southeast Asia to the US and Spain. The re-election of Donald Trump also posing a further risk as his incoming administration threatens a pullback on funding for climate science. Meanwhile, China is investing heavily in climate research, potentially putting it on track to become the world's next weather superpower. Our climate reporter Mary Hui joins us now from Hong Kong for more on this. Mary, why does China want to become a weather superpower?
So first, what is a weather superpower? The US is a weather superpower. Its data, its models are shared with countries around the world. Those countries depend on this US data for their own forecasting. The US also trains forecasters from around the world. It's at the cutting edge of a lot of climatological and meteorological research. And all of this has allowed the US to gain over the decades of efforts, both soft and hard power that through weather, and then extend that towards other domains to then advance and support its strategic interests. And China, of course, as a global, rising global hegemon, wants to do the same, or aspires to do the same. It wants to have that amount of influence and leverage over something as cross-cutting as the weather that affects all industries and all sectors of the global economy. And that's why it wants to be a global superpower. And this also aligns, actually, with some of its strategic goals that we've seen play out over the past decade or two. It wants to be less dependent on foreign technology in critical technologies and strategic domains. And this applies to weather as well. And at the same time, it wants to play a larger role in shaping the environment in which these critical technologies are developed and take place. So that means having a bigger role in bodies like the World Meteorological Organization and generally weather forecasting and monitoring work.
In what way are we seeing that sort of attempt to grow influence, dominance take place for China? And I guess what's the end game here in terms of how they're planning to use the data in this domain to Beijing's benefit?
So China has really ramped up its spending on what it calls weather diplomacy over the past decade. It's increased that amount of spending by about 500% from 2013 to 2023. What that means is it's spending more on, for example, sharing data with other countries, providing technological support to other countries' weather agencies, bringing forecasters from other countries to China to train them in new techniques and advanced methods. So all of that will position China to be in the place to play a larger role in global weather governance and climatological governance, which will eventually translate to both soft and hard power for Beijing, and through which it can advance more of its interests and shape the global order that it sees.
Our weather reporter Mary Hui there. More ahead on the Asia trade. This is Bloomberg. Shery, watching Tesla very carefully as we see that share price jumping to a record, and we know there's been so much scrutiny and also it's just so much enthusiasm from the investing community when it comes to anything that is Elon Musk related, right? Ever since he really secured his spot in very close proximity to incoming President Trump, and as well as a role potentially on his cabinet as well. But when it comes to that jump in Tesla shares, jumping to a record amid this $556 billion rally in just a 6-week period, that all-time high really being driven by a lot of optimism about Tesla's self-driving ambitions under the new Trump administration next year and onwards. We saw that jump of about 6% there, adding over $556 billion to the market cap since the US presidential election. So there's a lot more bullishness when it comes to the robo-taxi segment as well, because there is just that belief in the potential for a federal framework for self-driving vehicles in the US, and for that to really be accelerated, pun unintended, by the incoming Trump administration.
Yeah, so not surprising that Musk is now the first person to top that $400 billion of net worth. Now, your terminal function, as you might well know, is Rich Go, so you can check out the richest person in the world among his peers. But given that SpaceX is now the most valuable private startup in the world, one of the biggest catalysts for his wealth to jump was an insider share sale, and that boosted his net worth by roughly $50 billion. So we actually saw a one-day wealth jump of more than $62 billion for Musk, which is the largest on record, Haidi.
Yeah, Morgan Stanley's statement when it comes to Musk's entry into the political sphere has expanded investor thinking around the fundamental outlook for Tesla and potentially around some of his other companies as well, right? Like SpaceX. But take a look at how markets are tracking as we head into the start of trading in Seoul and Tokyo in the next few minutes. Seeing a little bit of upside as we await jobs numbers out of Australia. Nikkei futures looking pretty positive. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens and watching any market reaction to the US CPI print, which came in line with estimates, reinforcing bets, Haidi, that the Fed will cut rates next week. But of course, we do still have the ECB this week, not to mention the BOJ rate decision next week as well.
And so much consternation there has been about the rate path when it comes to Bank of Japan, right? And you see the move across the yen as well. We're also, of course, watching for some key labour market data out of Australia. We're expected to see sort of that moderating labour market growth and potentially a move higher when it comes to the unemployment rate. So does that move the needle when it comes to the RBA, given that expectations for the start of the easing cycle is all the way into practically the middle of next year? We'll have to wait and see, Shery.
We have seen significant weakness in the Aussie dollar, not to mention the Kiwi, given the dollar's gains also overnight. That report that Beijing is considering allowing its currency to weaken in order to be able to fight a trade war against the Trump White House. You're seeing the Japanese yen now at that 152 level against the US dollar, sort of holding steady. A lot of volatility in Japanese markets because, as we mentioned, we're really headed towards that BOJ policy decision, and traders and economists are a little bit confused right now about the messaging from the BOJ. The Nikkei is gaining more than 1% right now early in the session, as we're also watching Korean stocks. Take a look at how they're coming online after 2 sessions of gains. The Korean won has been trading sideways this week. A little bit of pressure given the news on Yuan weakness, perhaps. Guys, if you watch the board. There you go. The Kospi now up about 0.5%. The Kosdaq up 0.8% at the moment. And the Korean won sitting at that 14.29 level as we continue to watch the implications of the political chaos here in South Korea, Haidi.
Yeah, and let's take a look at how we're tracking. We're just an hour into the start of trading here in Australia. We are seeing a little bit of upside, about 0.4%. It's a pretty broad-based rally. We're seeing some of the energy names, consumer discretionary, some of the ones that are sort of showing some leadership at the moment in this early part of the trade. We're seeing some weakness, though, downside for Australian bonds ahead of the jobs numbers and, of course, coming off the back of US inflation as well. Really looking at that report for clues on the timing of whether we could see a change to the RBA's view for the start of cutting potentially in May next year, as how market expectations are kind of sitting at the moment. In terms of what we're expecting for those jobs numbers, likely 25,000 rise in employment compared with a slightly smaller increase in October. That jobless rate looking at 4.2% from 4.1%. If that happens, that will be the first sort of move higher in 4 months, and maybe that'd be kind of something that the RBA will be looking at a little bit more closely. You mentioned the Fed, of course. The inflation numbers didn't really do anything other than cement those expectations for those bets on a Fed cut, so very much in line with expectations, but still rising at that firm pace in November. And it's interesting, Amy Sir Patrick talking a little bit about, you know, if you look at the sort of core numbers and whether they are still quite sticky, still a lot of uncertainty, of course, given that we don't know what the fiscal outlook will be next year.
Yeah, Haidi, our next guest is expecting a 25 basis points Fed cut next week, and thinks the market might be pricing in too little in the weight of rate reductions next year. Joining us now is Dayeon Hong, multi-asset portfolio manager at Shinhan Asset Management. Great to have you back. So is it the expectation that the economy in the U.S. might not do that well in 2025? Do you think there could be more easing from now on out?
Well, so our view is that the Fed will go ahead with a 25 basis point cut next week. The data is on track for another cut. First, the labor market has been softening. We've had unemployment rate ticked up last month, and had the labor participation rate stayed at the same, unemployment rate could have gone even higher. Second is that inflation has been quite sticky, but we saw some positive signs from the data come out last night. The components that have kept the CPI high this year, such as rent prices and high insurance prices, have begun to show some signs of slowing down. So I would be surprised if the Fed did not go ahead with a rate cut this month. But looking at next year, I wonder if the market is pricing too little Fed cuts. Including the one in December, the Fed futures are currently pricing just over 3 cuts. And obviously, there are inflationary risks arising from potential tariffs. But what will be the impact on jobs created by the federal government as the new government comes in and the Department of Government Efficiency comes into action? Will we see unexpected rise in unemployment rate as a result? It's hard to predict at this juncture, but the developments in the labor market data will be much more crucial going into 2025.
So what are your expectations for Treasury yields right now? I want to take you to the question of the day by MLive strategist today. Will the 10-year yield retreat back to 3% in 2025 is the question for today.
We are expecting Treasury yields to go down from here. We were short duration previously, but as soon as the announcement of Trump's pick on Treasury Secretary, we quickly reversed our position to go long duration as a tactical trade. We'll still have to see what the actual policies will be next year, but at least the market took it as moderation of fiscal risks. And as I've mentioned, we're not really seeing such a huge jump in the CPI at this juncture, and we're seeing labor market data softening. So I don't really see, pressure for Treasury yields to move higher and see very little upside risks. We've also seen a decent auction demand for 10-year last night, not to mention the attractive yields in the US, especially from a foreigners' perspective. as the hedging costs are getting cheaper.
I wanted to get your views on China because we could be expecting some details from the Central Economic Work Conference as that wraps up today. We could have to wait until potentially into next year before those stimulus details are unveiled. Do you think the market at this point is getting ahead of itself, or it's very much managing expectations, given in a lot of aspects it's been a very muted reaction?
A lot of market participants are already talking about 4% fiscal deficit. And so the market may not move as much, even if we see some positive signs on the fiscal. We are yet to be convinced to go overweight in Chinese equities, largely because we have not really seen a meaningful pickup in domestic demand. It's also evident in CPI as well in China that it has been staying very low, and we've seen a downside move since the summer months. But we are mindful that the wording, the moderately loose from the PBOC, mentioned for the first time since the global financial crisis, and if boosted by proactive fiscal policy, including some special local government bond issuances, we could see more upside potential in growth potentially next year.
So at this point, you're not identifying any opportunities for China, even on the basis of comparatively, appealing valuations?
Yeah, we prefer to stay neutral at this moment. We will be looking out for further details of the stimulus.
We have seen reports that potentially Beijing could allow the currency to weaken in order to fight the trade war against the U.S. What would a currency devaluation in the yuan actually mean for Asian markets? How disruptive could that be?
I think it will have more depreciation pressure on the currencies in Asia. We've seen this picture before in the past where yuan was devaluated. It was a huge shock to the markets, and the dollar strengthened and Asia currencies weakened. And it will be particularly vulnerable to Korean won, for example, as we already seen some depreciation, but the broader dollar strength is really keeping the dollar won high. And it also means that the trade war and the concerns around the tariffs and trades are really escalating up. And so it will really not set a very good environment for Asia.
Dayeon Hong, really good to have you with us. Multi-asset portfolio manager at Shinhan Asset Management. Good to have you back. We have more ahead on the Asia trade. This is Bloomberg.
Wednesday, the Fed decides.
The consensus seems to be that you need a beat on payrolls, an upside surprise on CPI, and the Federal Reserve will hit pause.
Yeah, but it's pretty high bar. All of this seems very predictable.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
People feel good about where the economy is. Demand is obviously pretty strong. If there were black clouds on the horizon, what would they be?
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
China's annual economic work conference is setting policy priorities for 2025. That's set to wrap up on Thursday. The leadership is busy preparing its bargaining chips too for a potential trade war with the incoming Trump administration. Our chief North Asia correspondent Stephen Engel is in Hong Kong. So, we keep talking about a weakened economy in Beijing this time around, right? What tools does this leadership have at their disposal?
Well, they're trying to fine-tune those, obviously. I mean, we had the Politburo meeting earlier this week where they talked about what will be the economic priorities to shore up the domestic economy. Perhaps that's their best defense, obviously, at a time when there are multiple stresses on the Chinese economy. Of course, property being the biggest one, but the stock market has been languishing. Consumer confidence is extremely weak, and there's been persistent deflation for 2 years at the factory gate. So they have their issues. So boosting domestic consumption and boosting the Chinese local economy will be the best defense right now. But to counter some of these Biden administration moves on export controls of high-tech components and chips, AI chips and the like, as well as preemptively countering any increase in tariffs from the Trump administration, because he's telegraphed it pretty clearly. Tariffs are going to be his most favored word and will be essentially top of the agenda as soon as he comes into office on January 20th. So they have some time to kind of come up with those tools, those levers to counter that. But again, unlike the first Trump administration, the Chinese economy is significantly weaker than it was then. So they want to be able to show signs of strength, that they do have power to retaliate without necessarily disrupting what has been a relative calm in U.S.-China relations, even though it's a fragile calm, obviously. And they also don't want blowback on the local economy, obviously. They've been projecting strength in supply chain, projecting strength in their supply of critical key materials for the tech supply chain. But again, what can they do? Already in retaliation for the more recent Biden administration restrictions, they've opened a probe into NVIDIA. They've banned export of several key rare materials. They've limited sales of key components for U.S. manufacturers of drones. But what more can they do? Of course, we're going to talk about the currency. That is something they can do, but they're limited there as well. You know, as we had a guest on earlier last hour, that China, given its weak economy right now, is really incentivized to strike some common ground with the incoming Trump administration, given their domestic weakness right now.
Yeah, you mentioned the currency. So reports that potentially Beijing could try to or allow it to weaken against the U.S. dollar in this trade war. But the economic, the trade, the market implications of that would be huge.
Yeah, absolutely. I mean, look what happened in 2015 when the currency was suddenly devalued, and then there was market chaos, and the renminbi weakened by about 3%. And, you know, you can look at a 10-year chart and you can see how it's going. There's been an overall weakening trend, of course, to 7.269 or thereabouts right now. But this Reuters report really kind of shocked the market a little bit, that came out late yesterday, that's saying that the Beijing authorities are readying essentially a pathway of weakness towards 7.5 to the U.S. dollars. We saw base metals come down in response to that report, essentially because China's import bill will go up if they weaken the currency. But what we're likely to see is a managed weakness in the currency to help exporters and to make their exports cheaper. But we all know the threat of a sudden devaluation and a consistent weakness could spark outflows at a time when China is trying to attract inflows and keep its hard currency onshore. So there are lots of pitfalls to allowing the currency to weaken, including the import bill, including the outflows. So again, we've seen the PBOC-backed Financial News newspaper almost immediately come out with a commentary essentially saying the fundamentals are in place for a stable yuan. I'll just read you a couple of things. There's a solid foundation to remain, for the yuan to remain basically stable. In fact, they said the yuan could, the onshore, CNY, could strengthen, in fact, by year's end because of corporate FX settlements. And they went on to essentially caution against speculating and hoarding FX in order to avoid suffering additional losses. Now, clearly, the PBOC and the Beijing authorities do not want to see the sentiment move towards a one-way bet of a depreciating currency. They want stable currency at this critical time.
Chief North Asia correspondent Stephen Angle there. Well, outgoing US Treasury Secretary Janet Yellen says Donald Trump's plans for broad-based tariffs on China will hurt the US economy and provoke retaliation from Beijing.
Many countries, when they're faced with unilateral actions of that sort, look for ways to retaliate, and my guess would be that they would do that. We have in areas of concern where I've expressed repeatedly concerns with overcapacity that is developed in Chinese advanced manufacturing industries and clean energy, semiconductors, and the like. We think it reflects active, large subsidies that are flooding the world with exports and threaten to drive our firms out of business in areas that we think are critical to our own future. We've put in place tariffs. Now, they're strategic. They affected $18 billion worth of trade, certainly not all of our trade with China. And we did it to make sure that China's actions don't undermine our own plans to support these sectors. But broad-based tariffs, almost all economists agree that what they will do is hurt us by raising prices, possibly substantially, and making it more expensive for firms that need inputs from China to be able to acquire them, and harm our competitiveness of firms that rely on those imports. So we've taken a strategic approach, focusing narrowly, and a broad-based approach I have serious concerns with, as most economists do.
U.S. Treasury Secretary Janet Yellen speaking exclusively to Bloomberg. Now, South Korean President Yoon looks determined to battle on rather than step down early, even as investigations deepen into his martial law declaration, and more members of his party say they will back impeachment. The Hangyeoldae newspaper says the leader of Yoon's ruling People Power Party, Han Dong-un, could show support for the impeachment motion against the president as early as today. For more on the latest, we're joined by reporter Hee-Jin Kim. And Hee-Jin, we're now hearing from local media that President Yoon actually showed up at the office today. So what's the latest around where President Yoon stands? He doesn't seem to be backing down.
Yes, that seems to be true, although no one talks to Yoon. But seems like President Yoon Suk-yeol is really want to be impeached rather than stepping down by himself. But it doesn't sound like he's regretting what he did. But he's rather, trying to prepare something like for legal battle against the opposition party lawmakers, and to explain to public that why he made that decision and what was the background before the decision and what exactly happened on the day, because everyone is now attacking Yoon, and then a lot of military officials are under the investigation, and they are all, making testimony against Yoon. So it seems like Yoon is trying to explain to everybody about why he made that decision.
Because I guess then it goes to a constitutional court, and then the constitutional court has to uphold the impeachment motion. But in order for that to pass, which didn't happen last weekend, there weren't enough ruling party lawmakers to vote for the impeachment bill. Where are we at now?
Well, at least the 6 lawmakers publicly said that they're going to vote for impeachment, but we still need 2 more lawmakers, and then the vote will be held probably on this Saturday. And then a lot of other bunch of ruling party lawmakers said that they're going to definitely attend the parliament this week to vote, although they didn't say yes or no yet. But definitely it's a good signal, positive signal, at least to see that there will be more ruling party lawmakers at the assembly. Because last time when I was there were only less than 10 lawmakers at the parliament, but it's actually a positive sign. And then they're actually under huge pressure from the businessmen and markets, analysts, and everyone says this should be wrapped up as soon as possible.
Yeah, we have seen the protests, we've seen labor unions also striking. Tell us a little bit about the process of what this could end up looking like, because if he's impeached, upheld, and there's elections, what does this look like, and for how long could this continue?
Yeah, I mean, unfortunately, it's going to take like several months for us to actually see Yoon is leaving the office, because even if they pass the motion for impeachment, and there will be a vote this weekend, and then there's going to be another ruling by the Constitutional Court, which will take about 6 months.
Hee-Jin Kim, Bloomberg News, really with those details about what to expect here in South Korea as we continue to see the protests for President Yoon Suk-yeol to step down. And of course, as this uncertainty continues, we are taking a look at the markets that have stabilized somewhat. You can actually see the Kosdaq gaining about 1.5%, while the Korean won is also holding against the US dollar. We had seen a little bit more pressure on the yuan, also being pressured by that report that Beijing might allow the Chinese currency to depreciate. But right now, Korean markets looking steady. This is Bloomberg. Take a look at how European futures are coming online in the Asian session. We are seeing not a lot of movement after stocks rose overnight. Reaction to the U.S. inflation data that came in line with estimates and solidifying a potential rate cut from the Fed. This, of course, as we're headed towards the ECB policy decision as well. The expectation for lower rates by 25 basis points. Haidi, the outlook for inflation and GDP growth in Europe, both darkening since the last ECB decision.
Could get a whole lot more challenging going into next year with these trade tensions. But Shery, taking a look at some of the other stories that we're following globally, and FIFA has confirmed Saudi Arabia as host of football's 2034 World Cup. It marks a victory for the Crown Prince Mohammed bin Salman and his push to build influence amid concerns over the nation's human rights record. Riyadh was the only bidder for the event after Australia dropped out. Matches will be held across 5 cities in 15 different venues, 11 of which are yet to be built. The Biden administration has warned that Russia may fire another intermediate-range ballistic missile at Ukraine, similar to the one that it used in an attack last month. The warning came as the Russian Defense Ministry promised to respond to Ukraine, hitting a military airfield with what it says were US-supplied missiles. Both sides have recently ratcheted up missile attacks in the nearly 3-year war. A suicide bombing in Kabul has killed a senior Taliban minister, the highest profile casualty since the group retook power 3 years ago. The victim was a senior member of the Haqqani network. It's a militant group responsible for some of the bloodiest attacks against US forces in Afghanistan. There was no immediate claim of responsibility for the blast. More ahead on the Asia trade, this is Bloomberg. We are taking a look at what we're watching when it comes to the jobs numbers out of Australia. The November employment number rising 35,613, significantly higher than expectations of around 25,000. When it comes to that jobless rate, it actually fell to 3.9%. The estimate had been a rise to 4.2% from the previous reading of 4.1%. The participation rate dropping just a little bit to 67%. From 67.1 was the estimate, I should say. And we're seeing part-time employment falling by just shy of 17,000 roles, full-time employment rising by 52,571 there. Let's get some reaction with Garfield Reynolds in terms of whether or not this sort of, moves a needle at all when it comes to the RBA. He, of course, leads our Markets Live Asia coverage. So on a number of fronts, these numbers are so much stronger than expected.
Yeah, it certainly doesn't offer those who expect the RBA to cut as soon as February, much grist for that mill, given that the labour market is not deteriorating in such a way as to push from that side of things. Now, if inflation numbers, in particular the quarterly figures that come out late January, if those come in significantly weaker than the RBA has been expecting, then that could increase their confidence about the idea that they're on track to get inflation back where they want it to. So that could allow a rate cut, but this is a very strong set of numbers. This gives the lie to the idea that the Australian jobs market at least is cracking under the strain of the RBA's highest interest rate in many, many years.
We are seeing the Aussie extending that gain there.
And Garth,
perhaps unsurprisingly, this is the 7th beat over the past 8 prints, Shery.
Yeah, I mean, these numbers are quite surprising. But Garfield, what about the US inflation print? Because that came in with estimates and the implications, I guess, not only for the Federal Reserve, but also because we do have the ECB coming up.
Yeah, the inflation numbers overnight from the US were, on the one hand, rather dull. They came in pretty close to expectations, so everybody's all lined up for a rate cut next week from the Federal Reserve. On the other hand, they did continue this underlying concern that some of the core numbers that the Fed has tended to say it worries most about are showing signs of ticking up or of remaining sticky. So the concern is that you're going to get quite a hawkish cut from the Fed next week. For the ECB, that does complicate matters somewhat as well. They're definitely going to cut. The question is, how open do they want to be to rapid ECB cuts in the coming year? Because if they're too open to that, that could send the euro noticeably lower, which would complicate matters on a range of fronts, including too low a euro can act as an inflationary driver. And while there's been some concern that a Trump presidency will impact the European Union pretty strongly on the trade war front, as the RBA governor said yesterday, we have very little clue as to what he will actually do once he is in office. So the question is, do the ECB want to front run that at all?
Garfield Reynolds, who leads our Markets Live Asia coverage there, and we're watching that sort of reaction when it comes to the commodity space there as well, particularly in light of we're also hoping to get some more details out of the fiscal plan from China as that Central Economic Work Conference wraps up later today. And of course, when it comes to energy, oil prices are really seeing that tension with the possibility of further sanctions against Russia being signalled by the US. We have seen oil just holding on to that advance on those geopolitical risks could potentially allow for further sanctions on Russia's energy sector. So that is sort of what's at play when it comes to oil, which has been, of course, been pretty range-bound given the concerns about the glut outlook for next year and some of the weakness in demand there. Watching base metals, they have been swinging a little bit lower after the yuan fell on the back of that report that Beijing would consider letting the currency weaken next year as perhaps one of the responses that it has in the toolbox to a potential trade war. Well, OPEC has further cut its oil demand growth forecast for this year and next. Its extended alliance agreed to extend existing supply curbs. Let's bring in Bloomberg senior energy reporter Stephen Stupczynski in Singapore. And Stephen, even as we kind of grapple with multiple fronts of geopolitical uncertainty, a bit of a question mark in terms of how much stimulus and its effectiveness for China, it feels in a lot of ways with this range-bound trading that we've seen in the price action that, traders and perhaps, the oil nations themselves can see the writing on the wall on the demand side.
Yeah, I mean, it's very interesting. I think the OPEC story, they've cut their outlook for 2024 and 2025 for the 5th straight month. Their oil demand outlook for 2024 has dropped about 27% since their estimates in July. And that, OPEC is the most bullish when it comes to oil demand. They're one of the few organizations that is forecasting oil demand to keep rising to the middle of the century. So the fact that they're cutting it back every month indicates that their initial forecasts were just not on the mark. They were expecting a stronger picture. And when you look at China, as you mentioned, it just isn't there. It's not really lifting demand as much as people expected, despite rolling back COVID sanctions years ago. There's a really big EV story happening in China at the moment, and gasoline demand isn't as robust as you would have seen in previous years. Plus, the economy isn't growing as strongly as some had expected. So that altogether paints a pretty bearish picture. OPEC also flagged that that South America as well had flagging demand there. So overall, it's a pretty bearish outlook. And yes, oil majors do see the writing on the wall. Of course, they want to continue to figure out ways to squeeze profits out of this sector, out of fossil fuels. But at the same time, they're charting a future where oil isn't their main profit.
Are geopolitical tensions going to move the needle when it comes to prices for energy, though? What are the expectations for where price goes in 2025?
I mean, I think you look at what the outgoing Biden administration is doing with potentially stronger sanctions on Russia, if that's a geopolitical risk you have there. And that sort of helped lift the market. But it's an interesting story, these sanctions, because in an interview with Treasury Secretary Yellen yesterday on Bloomberg TV, she indicated that these sanctions are coming into place because the market is softer in 2025. They're able to put more sanctions on Russia and Russian crude because if they take those barrels off the market, or if it becomes harder for Russia to export those barrels, you won't see a price shock that you would have seen when the market was tighter, let's say in 2022, at the peak of the energy crisis. So yes, there is a geopolitical risk. You also have what's happening in a lot of unknowns in Syria and how that could affect the wider region, what's happening with the Israel-Hamas war, as well as reactions from Iran and how the Trump administration could potentially look at Iran and try to tighten sanctions on that regime as well. So there are geopolitical risks that could raise prices. But overall, the market, the fundamentals, when you just look at the supply and demand, supply is robust outside of OPEC. They had to curb their output, but shale production is still quite strong. And at the flip side, demand, as I had highlighted, in China and other places is just not living up to where traders thought it would be. And that's painting quite a bearish picture for the next year.
Our Bloomberg senior energy reporter Steven Stupczynski, they are joining us from Singapore. Take a look at how some of these power companies trading across Asia are looking right now. Of course, we have been watching them very closely, given that it's getting colder and colder and that winter energy demand will continue. In fact, in Tokyo, now the Japan Meteorological Agency expecting temperatures to fall to about 3 degrees. And of course, here in South Korea, we're in sub-zero temperatures. But global energy demand really has skyrocketed on AI ambitions. And proponents of nuclear power are now saying that it's the best way to meet that demand without adding to carbon emissions. Bloomberg NEF says at least 15 countries are now building new reactors, while the Yuan's nuclear agency predicts capacity from atomic power could jump 24% by 2030 from levels 2 years ago. And almost 14 years after the Fukushima disaster, the nuclear debate is heating up again in Japan as it looks for ways to supply power-hungry AI data centers and chip-making plants. Let's get more on this with Dale Klein, chairman of Tokyo Electric Power Company's Nuclear Reform Monitoring Committee. Dale, great to have you with us. So we continue to see big tech really power-hungry at this point. Do you expect that sort of demand to continue into 2025? And are we ready to meet that challenge?
Well, Shery, I think the area of nuclear energy had been growing a lot just with carbon reductions. But now we're looking at this, as you indicated, the great demand for AI. And so that's really going to cause, I think, electricity demand in Japan to really increase. And if we're going to maintain our lifestyle, our standards, we cannot meet it without nuclear energy.
In a country like Japan that had, of course, recently suffered from the Fukushima nuclear disaster, there are many hurdles, both when it comes to society's feelings, not to mention legal hurdles as well. Can they be cleared in time for this supply to be really boosted to the levels necessary in this new technological era?
Well, Shery, we have two things going on at the same time. One is a global issue of reducing our carbon emissions, and that will continue. But the real change in demand is with these data centers. For a country like Japan that imports about 98% of its fossil fuels, Japan really needs to look at energy security. I think you saw what happened, electricity prices in Japan when Russia invaded Ukraine. It caused an interruption in our LNG supplies worldwide. Those kinds of activities will really lead Japan, I think, to have a strong energy policy that includes nuclear as a key component of its energy strategy.
A key component, will it be a leading component, or is it always sort of destined to be a secondary source to renewables, potentially even more to fossil fuels?
Well, Heidi, I think in the short term, it's going to be fossil fuels just because the demand is going to occur rising so fast that we will not have time to build nuclear plants initially. But one thing that Japan has always done, they've had a long-term look as how they're going to meet their energy demands for the long haul, and that's where nuclear will come in. Short term, we expect to see a lot of natural gas used for electrical demand to meet the AI increased demand. But then long term, it will have to be nuclear for that reliable 24/7 operation.
In the US, there's actually bipartisan support for nuclear energy, right? And there are expectations that we could see this take place as part of a Trump administration framework. What are your expectations in terms of what we could see over the next 4 years?
Well, I think, Heidi, for the next 4 years, we're initially going to see a lot of natural gas plants built in the U.S. because we have a lot of natural gas, particularly out of the West Texas region of the Permian Basin. So short term, we'll see a lot of natural gas plants built to meet the AI demand. But long term, we will see small modular reactors. We will see large reactors. We just cannot meet this big demand for these data centers without nuclear playing a part if we're going to maintain a reduction in greenhouse gases.
Dale, TEPCO became a global name, a household name, especially after the Fukushima nuclear disaster and how you struggle to deal with the aftermath. What has TEPCO done so far in terms of safety reforms for really safely operating these reactors in the future?
Well, as a former chairman of the U.S. Nuclear Regulatory Commission, safety is the forefront of my concept for TEPCO. The Fukushima accident was just an unfortunate event. They were not expecting to see that large of an earthquake and that large of a tsunami. And so TEPCO has really changed the way they operate. They're looking more at a safety culture. They're putting a lot more enhancements for backup safety systems in place. Right now, Japan gets about 8.5% of its electricity from nuclear. If they're going to reduce their greenhouse gases, meet the AI demand, nuclear will have to play a role in Japan, and TEPCO will have to earn the trust of the public by safe operation of their facilities as they move forward.
Dale, what are the practical implications when it comes to the challenges of restarting nuclear reactors, and how is TEPCO looking at those and trying to overcome them?
You know, it's really a slow process when you look at the amount of time that it's taken to restart a lot of the nuclear plants in Japan. We have a new regulatory agency that was established. They're getting their requirements into place. And then there's a lot of consensus building that goes on, as you know, in Japan. And so the public policy is a very important part of that. At the end of the day, if Japan is going to maintain their manufacturing supply chain, all of their activities, they're going to have more and more electricity. and they have stated publicly that they want to reduce their CO2 emissions. So TEPCO has an opportunity to play a lead role in this area as they look at how can they generate electricity safely, security, and for the long term.
Dale Klein, chairman of the Nuclear Reform Monitoring Committee for Tokyo Electric Power Company. Thank you very much for joining us today. We do have some lines, Heidi, crossing the Bloomberg right now as we're hearing from President Yoon speaking on a taped message to the public saying that he thinks that the opposition party didn't recognize him as president, that the main opposition tried to pull down the people. This, of course, as we've now heard from local media, that he appeared in office for the first time today for about 30 minutes. And as we're also getting some lines coming from the ruling party leader, PPP, Han Dong-un, saying that he confirmed with President Yoon that he will not be exiting early, that the impeachment way is the only way to stop Yoon's duty from now on, and that PPP, ruling party lawmakers, should vote based on their conscience. Remember, last weekend, the opposition parties could not get enough ruling party lawmakers to vote for the impeachment bill, but now the leader of the ruling party is saying that they need to penalize President Yoon. Yoon speaking at the moment in a taped message, also saying that the opposition party was trying to paralyze the administration. We'll continue to monitor these lines, but it seems that the political standoff continues, and there's a lot of finger pointing of how the martial law was declared in the first place. Right now, we're hearing from President Yoon. We'll be continuing to watch the markets as we continue to see more stabilization, though, when it comes to Korean stocks and the currency as well. This is Bloomberg.
Hong Kong's New World Development has reportedly sold an industrial building for $80 million as it offloads non-core assets to help address a liquidity crunch. The indebted developer has been facing pressure to manage its finances on top of recent leadership changes. Now, the next test could be its perpetual bonds, with some $4.5 billion outstanding. Bloomberg opinion columnist Julie Ran joins us now from Hong Kong. So, what's really prompting these concerns that New World may not call its perpetuals or even pay coupons next year?
So the perpetual bond, whether it's debt or equity, has always been a matter of debate for traders. The catalyst was perhaps came from 1 month ago when a smaller developer decided not to pay coupons to its perpetual bonds. And then that got traders really worried, because technically New World can choose not to pay coupons or not to call its perpetual bonds. And we all know New World has a lot of cash issues. I mean, they were trying to sell the assets to boost up their balance sheet, but the asset disposal has been quite slow. There were two chief executive changes in the last 2 months. So investors are getting very worried that no one at the top is responsible to bondholders.
We've seen Chinese developers defaulting since 2021. Could the developers in Hong Kong now become distressed?
I think they are not quite distressed yet, but there is definitely there are definitely concerns, market concerns. I think one difference between the Chinese and Hong Kong developers is that we all know the Chinese developers, they basically made money in the last 10 years. Their empires were built basically like a house of cards, whereas the Hong Kong developers, a lot of them came from very wealthy families, right? They, like in New World Development's case, the parent family, they made a lot of money from Chow Tai Foh, this jewelry shop. So we know that the Hong Kong developers have more money, at least the families have more money. The question is whether the families will come out and bail out their subsidiaries.
What does this ultimately say about Hong Kong right now as a global financial centre?
I think if you just look at New World Development's perpetual bonds, they were issued just 3 or 4 years ago, right? And back then, like all the global investors just thought they were so golden. Like no one questioned that the Hong Kong tycoon families are crazy, filthy rich. But these days, people are stepping back and say, okay, can Hong Kong tycoon families play a dirty game internationally as well, just like the Chinese developers? And I really think it's putting a dent to Hong Kong's reputation as a financial center.
Our Bloomberg opinion columnist Shery ran there in Hong Kong. We do have more ahead on the Asia trade. This is Bloomberg.
Take a look at President Yoon speaking in a taped message in South Korea, saying that the opposition party was the one that was threatening national security and social safety, that the opposition is actually taking North Korea's side. He said that the imposition of martial law was to send a warning to the opposition by letting the public know of their what he calls anti-state moves. He's saying that the opposition was taking Pyongyang's side, that they were very large and they became a monster to destroy public order in South Korea, that there were lots of serious issues that he couldn't reveal. So President Yoon right now trying to explain to the public why he went ahead with that shock declaration of martial law. As we also just heard from the ruling party leader Han Dong-hoon that he had confirmed that President Yoon wouldn't be exiting early and that impeachment was the only way to stop Yoon. So Haidi will continue to watch the developments as we're headed towards another potential impeachment vote on Saturday.
As we potentially get closer to some degree of certainty, but still so much upheaval there where you are in South Korea. We're also seeing an upheaval when it comes to these RBA expectations for Australia. Take a look at that move that we see, particularly when it comes to the 3-year yield rising 10 basis points, that RBA rate cut expectations. Those bets are just being pushed back now. Slumping that we're seeing in Aussie bonds, that jobs data really very strong across the board, could be delaying that cut.